Silver occupies a measurable position within global balance sheets, industrial supply chains, and monetary inventories, with annual production consistently below 1 billion ounces, while demand spans electronics, energy infrastructure, medical applications, and long-standing monetary reserves. This places the metal in a structural contrast where physical throughput remains constrained while systemic dependence continues to broaden. The scope of this analysis is limited to reconstructing how silver's classification, accounting treatment, and systemic role diverge from common public framing. In early 2025, updated aggregate asset tables circulated across multiple institutional research desks following routine balance sheet reconciliations and commodity exposure disclosures. These tables did not originate from a single announcement or press release, but from the convergence of regulatory filings, derivatives, exposure summaries, sovereign reserve statements, and industrial input accounting. Within those reconciliations, silver repeatedly appeared not as a niche commodity, but as a consolidated asset class whose total above-ground valuation exceeded multiple traditionally cited categories when measured by functional deployment rather than headline pricing. The data points themselves were not new. What changed was the method of aggregation. Instead of isolating silver into a single commodity line, the accounting incorporated bullion inventories, embedded industrial stock, exchange-registered holdings, and monetary substitutes tied to silver settlement. Once consolidated, the resulting figure placed silver behind only 2 asset categories on a global scale, based on total functional exposure. No interpretation accompanied these tables. They were circulated internally as reconciliation artifacts. At the administrative level, nothing appeared irregular. Markets continued to operate, exchanges cleared as usual, and industrial procurement schedules remained unchanged. Silver contracts settled daily, refineries delivered within expected tolerances, and inventory reports reflected familiar fluctuations. From the outside, the system appeared stable. Price movements remained within historical bands, volatility metrics did not signal disruption, and no emergency policy language emerged from financial authorities. This outward normality is a critical condition. Structural stress rarely announces itself through immediate surface instability. Instead, it accumulates quietly within classification systems, accounting conventions, and settlement mechanics that continue to function even as their internal assumptions drift. The central question is not whether silver is undervalued or overvalued, nor whether its price should change. The question is how a material can function simultaneously as an industrial input, a monetary residual, a derivative settlement anchor, and a reserve substitute without those roles being reconciled within a single systemic model. When aggregation methods change, they do not create new assets. They reveal existing interdependencies that were previously segmented. Once those segments are combined, the system must be examined under a different frame. This report does not forecast prices, recommend allocations, or attribute intent to institutions. It documents publicly observable mechanisms, reconciles structural roles, and examines where accounting symmetry no longer holds. Following the initial reconciliations, further documentation clarified how silver exposure propagates through multiple layers of the financial system. Physical bullion held in vaults represents only a fraction of total exposure. Exchange-registered inventories, while reported as discrete quantities, are simultaneously referenced by futures contracts, option structures, and collateral frameworks. Industrial silver embedded in finished goods is rarely treated as an asset on balance sheets, yet it represents recoverable material with monetary equivalence under stress conditions. In parallel, sovereign mints continue to issue silver-based legal tender instruments, which occupy a hybrid classification between currency and commodity. None of these categories are controversial individually. The tension emerges only when they are summed. Clearinghouses treat silver contracts as liquid instruments under normal conditions. Margin requirements assume orderly delivery optionality, where most contracts net out financially rather than physically. This assumption has held historically because industrial demand, recycling flows, and mine supply have remained loosely balanced. However, the reconciliation documents did not assess future balance. They assessed present exposure. In doing so, they highlighted that the same ounces are referenced multiple times across different systems, each assuming priority under different conditions. Institutional responses to these reconciliations were procedural rather than reactive. Risk committees reviewed exposure overlaps. Compliance teams ensured disclosures remained consistent with reporting standards. No directives were issued to alter trading behavior. This is consistent with how large systems respond to structural revelations that do not yet impair function. Adjustment occurs through documentation first, not through action. The analytical frame therefore shifts from market behavior to system design. Silver's role expanded over decades, not through a single decision, but through incremental necessity. Electronics manufacturers adopted silver for conductivity efficiency. Energy systems integrated it into photovoltaic infrastructure. Medical applications relied on its antimicrobial properties. Financial systems retained it as a legacy monetary reference even after formal demonetization. Each adoption was locally rational. Collectively, they created a multi-domain dependency. At this point, the question becomes whether a system built on segmented assumptions can remain coherent when those segments converge under stress or reclassification. The reconciliations did not answer this question. They merely made it unavoidable. From a historical perspective, commodities that occupy both industrial and monetary roles tend to generate classification ambiguity. Gold resolved this by gradually shedding most industrial functions, allowing its monetary role to dominate. Silver followed a different path. Its industrial utility expanded faster than its monetary role contracted. As a result, it never fully exited either domain. The system adapted by treating these domains as analytically separate, even though they reference the same physical material. The continuation of the anchor event documentation shows how this separation is maintained operationally. Futures exchanges allow for cash settlement to avoid delivery congestion. Industrial users maintain just-in-time inventories rather than strategic stockpiles. Sovereign entities report silver holdings under miscellaneous categories. None of these practices are erroneous. They are optimized for efficiency under stable conditions. The issue is that efficiency assumptions depend on elasticity that may not exist simultaneously across all domains. As exposure mapping continued, analysts noted that silver-linked financial products had proliferated quietly. Exchange-traded vehicles, structured notes, leasing arrangements, and collateralized lending facilities all reference silver either directly or indirectly. Each product assumes liquidity from a different source. Some assume mine supply responsiveness, others assume recycling scalability, others assume contract netting. These assumptions are compatible individually, but not necessarily collectively. The framing, therefore, shifts again. This is not a story about demand overwhelming supply in a linear sense. It is about multiple claims on the same material operating under different priority rules. When systems function normally, priority is irrelevant. Under constraint, priority becomes decisive. The historical context for this dynamic extends beyond modern markets. Periods where silver occupied mixed roles have repeatedly produced administrative tension rather than immediate price disruption. Monetary authorities in past centuries struggled to maintain bimetallic standards precisely because silver ES availability fluctuated with industrial and geographic factors. Modern systems replaced explicit standards with implicit mechanisms, but the underlying material constraint did not disappear. The early stages of structural divergence are often marked by increased documentation, not by market signals. That is the phase observed here. The reconciliations triggered further internal modeling, scenario analysis, and cross-departmental review. None of these processes are publicized. They are routine responses to complexity. What matters analytically is that silver ES aggregate functional exposure now exceeds the capacity of any single domain to absorb disruption independently. Industrial users cannot easily substitute it at scale without redesign. Financial systems cannot instantly unwind layered references without settlement friction. Sovereign entities cannot reclassify holdings without accounting consequences. The system therefore relies on continued smooth operation across all domains simultaneously. This reliance is not a prediction of failure. It is a description of dependency. Systems with high dependency density require proportionally higher coordination to remain stable. When coordination is implicit rather than explicit, stress manifests as administrative adjustment rather than visible crisis. As the anchor event documentation concludes, the classification of silver as a minor commodity no longer aligns with its documented systemic role. This misalignment does not force immediate change. It creates a persistent analytical gap. The remainder of this analysis reconstructs how that gap formed, why it remained unaddressed, and what structural conditions determine how long it can persist without resolution. The structural position silver occupies today did not emerge from a single policy decision or market transformation. It developed through recurring historical cycles where materials that served both productive and monetary functions were repeatedly reclassified without ever being fully resolved. Each cycle reduced visibility rather than dependency. Understanding this requires stepping back from modern market instruments and examining how systems historically absorb materials that cannot be cleanly categorized. In pre-industrial economies, silver functioned as circulation medium, unit of account, and store of value precisely because its physical properties aligned with transactional needs. Its conductivity, malleability, and divisibility made it practical for minting, while its relative scarcity imposed discipline. As industrialization progressed, those same properties became inputs rather than monetary attributes. The transition did not eliminate silver's monetary relevance. It diluted it across jurisdictions and institutions. Governments suspended convertibility, adjusted mint ratios, or demonetized silver formally, but the metal itself remained embedded in economic function. The 20th century introduced a structural shift. Monetary systems detached from metals, but industrial systems scaled exponentially. Silver demand from photography, electronics, medical equipment, and later renewable energy did not replace its monetary role. It layered on top of it. Financial systems, in turn, retained silver as a hedgeable, deliverable, collateralizable reference precisely because it remained physically real, globally recognized, and historically monetary. The system never reconciled these layers. It compartmentalized them. This compartmentalization is visible in how institutions model silver. Industrial planners model it as an input with supply curves, substitution thresholds, and recycling rates. Financial institutions model it as a liquid asset with volatility profiles, margin requirements, and correlation metrics. Sovereign entities model it as a residual reserve, often grouped with miscellaneous metals or legacy holdings. None of these models are incorrect. They are incomplete when viewed in isolation. The structural model that emerges is not linear. It operates in stages. In the initial stage, silver is abundant enough that no single domain dominates allocation. Price signals suffice to coordinate distribution. Recycling flows respond with lag, mining adjusts marginally, and inventories buffer shocks. This stage has defined most of the modern era. In the next stage, industrial demand becomes non-discretionary. Silver is no longer a marginal input, but a design-dependent component. Substitution becomes technically possible, but economically or temporally constrained. At this point, industrial users prioritize continuity over price sensitivity. This does not remove silver from financial markets, but it reduces elasticity on one side of the system. Simultaneously, financialization deepens. Silver-linked instruments proliferate because they are easy to reference and historically liquid. Futures, options, structured products, and lending arrangements assume that physical settlement remains a backstop even if rarely exercised. The system relies on netting. As long as most positions offset financially, the physical layer remains dormant. The third stage emerges when these assumptions overlap. Industrial users require uninterrupted physical flow. Financial systems maintain layered claims. Sovereign and institutional holders retain inventories as strategic or legacy assets. None of these actors intend to stress the system. They act independently under rational constraints. The conflict is not behavioral, it is structural. At this stage, accounting conventions begin to matter more than market prices. How silver is counted, where it is reported, and which claims are considered senior become relevant questions. The reconciliation documents referenced earlier are characteristic of this phase. They do not trigger action. They surface incompatibilities. From a mathematical perspective, the system relies on an implicit assumption that the same ounce of silver can satisfy multiple potential claims because not all claims will be exercised simultaneously. This is not unique to silver. It exists in many financial systems. What differentiates silver is that its industrial claims are physical and time-sensitive, while its financial claims are contractual and flexible until they are not. The base arithmetic illustrates the constraint. Annual mine supply grows slowly due to geological, regulatory, and capital limitations. Recycling responds to price, but with delays, and diminishing returns as easily recoverable sources are exhausted. Industrial demand grows with infrastructure deployment and technological diffusion. Financial exposure, however, can expand orders of magnitude faster because it is not bound by physical throughput. This creates a divergence between reference volume and deliverable volume. As long as financial claims remain largely notional, the divergence is manageable. Problems arise when conditions require conversion from notional to physical. The system is designed to discourage this through cash settlement, incentives, and liquidity provision. These mechanisms are effective until they encounter actors for whom physical delivery is not optional. This is where silver's dual role becomes irreducible. Industrial users cannot accept cash settlement in place of material without halting production. Energy systems cannot substitute accounting entries for conductive inputs. Medical and technological applications depend on physical properties that cannot be replicated by financial instruments. Historically, systems encountering this mismatch respond by reprioritizing implicitly. Industrial allocation tends to be protected through contracts, long-term supply agreements, and strategic stockpiling. Financial claims adjust through pricing, margin changes, or settlement modifications. These adjustments are not failures, they are adaptations. However, they reveal which claims are ultimately subordinate. The advanced stages of the structural model involve convergence. As dependency density increases, coordination requirements rise. Exchanges may adjust delivery rules. Clearinghouses may alter margin frameworks. Regulators may revisit classification standards. None of these actions require public crisis. They are incremental recalibrations designed to preserve function. The inevitability discussed here is not directional in price terms. It is structural in resolution terms. Systems that rely on unresolved dual classifications eventually formalize hierarchy. The question is not whether silver remains important. It is how its importance is administratively expressed. Mathematically, the system does not close cleanly if all claims are treated as equal. It closes only if priority is established. That priority can be explicit or implicit. Historically, it has tended toward protecting physical continuity over financial optionality. This does not imply collapse or disruption. It implies redefinition. Silver transitions from being treated as a flexible financial reference to being recognized primarily as constrained infrastructure material with monetary characteristics. That transition can occur quietly through accounting changes rather than market shocks. The analytical significance of silver appearing as one of the largest aggregate asset exposures lies here. It is not a statement about valuation. It is evidence that the system has reached a scale where compartmentalization obscures dependency. Once revealed, the system must adapt, even if slowly. The remainder of this analysis examines how such adaptations typically unfold over time, how scenario timelines emerge without prediction, and which risks and counterarguments must be considered to avoid overstating structural conclusions. As the system progresses beyond the intermediate stages of structural overlap, the distinction between optional and non-optional claims becomes increasingly relevant. This is not resolved through declaration or policy announcement, but through gradual procedural adjustment. Advanced stages of convergence are characterized by silent recalibration rather than visible rupture. Institutions begin to behave as though hierarchy already exists, even if it is not formally stated. In these later stages, financial references to silver increasingly assume continuity rather than availability. Contract language evolves subtly. Delivery clauses emphasize alternatives. Margin frameworks incorporate stress assumptions that were previously theoretical. None of these adjustments invalidate existing instruments. They narrow the circumstances under which physical resolution is expected. This effectively shifts financial exposure toward abstraction while preserving nominal linkage. At the same time, physical allocation becomes more tightly managed. Long-term supply agreements expand. Industrial users extend contract duration and diversify sourcing geographies where possible. Strategic inventories grow quietly, not as speculative accumulation, but as operational insurance. These actions are not coordinated centrally. They emerge independently across sectors, responding to the same constraints. This convergence produces a system where silver remains widely referenced, but increasingly difficult to mobilize freely. The material continues to circulate, but with reduced slack. The appearance of liquidity persists, even as flexibility diminishes. This is a common feature of mature systems operating near physical limits. The mathematical closure of such a system depends on constraint recognition. In earlier phases, models assume elasticity that no longer exists. Advanced modeling incorporates bottlenecks, time delays, and priority rules. When these are included, the system ceases to balance under symmetric assumptions. It balances only when certain claims are treated as contingent rather than absolute. This does not imply that financial claims are invalid. It implies that they are context-dependent. Under normal conditions, they function seamlessly. Under constraint, they adapt. The adaptation mechanism is not price alone. It includes settlement structure, regulatory tolerance, and institutional behavior. The timeline over which these adaptations occur is not fixed. It unfolds through scenarios rather than forecasts. In one scenario, technological substitution reduces pressure by lowering silver intensity per unit of output. In another, recycling efficiency improves marginally, extending equilibrium without resolving dependency. In yet another, administrative reclassification reduces apparent exposure without altering physical reality. These scenarios are not mutually exclusive. They can overlap and sequence. What they share is gradualism. Structural systems favor continuity. Abrupt change is avoided unless forced. As long as silver flows continue and settlement mechanisms function, adjustment remains incremental. This can persist for extended periods, creating the impression that no resolution is required. Risk analysis must therefore address not collapse scenarios, but misinterpretation risks. One risk is assuming that aggregate exposure equates to immediate scarcity. It does not. Another is assuming that administrative adjustments signal manipulation or intent. They do not. A third risk is conflating systemic importance with directional outcome. Importance increases sensitivity, not predictability. Counterarguments often focus on substitution potential, technological innovation, or market efficiency. These are valid considerations. Silver demand per unit has declined in some applications. Alternatives exist in specific contexts. Markets have historically managed commodity transitions. None of these points negate the structural observation. They influence its pace and expression. Another counterpoint is that financial systems have operated with layered claims on physical assets for centuries without failure. This is also accurate. The distinction lies in the nature of the physical claims involved. When physical demand is discretionary, financial abstraction dominates. When physical demand is infrastructural, abstraction becomes conditional. The final stage of systemic adjustment is normalization. Once hierarchy is implicitly accepted, the system stabilizes around it. Silver continues to be traded, referenced, and utilized. Its classification shifts subtly. It is no longer treated primarily as a flexible financial commodity. nor purely as an industrial input. It occupies a constrained hybrid role that is acknowledged operationally, even if not rhetorically. This normalization does not require public acknowledgement. It manifests through unchanged outcomes under changed assumptions. Markets clear, industries operate, institutions report. The difference lies beneath the surface in how contingencies are modeled and how stress is managed. The purpose of this analysis has been to reconstruct the structural conditions under which silver's aggregate exposure reached its current scale, to explain why this scale remained obscured by compartmentalization, and to outline how systems historically adapt when such compartmentalization becomes unsustainable. It does not assert inevitability of disruption, only inevitability of adjustment. Monitoring such systems requires attention to procedural signals rather than headlines. Documentation changes matter more than commentary. Settlement rule modifications matter more than price spikes. Inventory behavior matters more than narrative framing. As long as silver remains embedded across industrial, financial, and residual monetary domains simultaneously, the system must continue balancing competing assumptions. The resolution of that balance is not dramatic. It is administrative. It unfolds over time, and it is visible primarily to those examining structure rather than surface. The analysis therefore remains open-ended, not because outcomes are unknown, but because structural systems rarely conclude. They evolve, recalibrate, and persist. Observing that process requires patience, discipline, and an understanding that significance does not always announce itself. What follows is not a conclusion, but a continuation.